All right, today we're going to break down a financial theory with a name that, honestly, tells you almost everything you need to know, the bird in hand theory. Let's get right into it. You've heard this a million times, right? It's classic wisdom. Something you have for sure is way better than something you might get later. Well, what's so cool is how this one simple idea forms the basis of a huge debate in finance about what companies should do with their profits. So, okay, how does an old saying about birds connect to your stock portfolio? That's the real question, isn't it? We're going to see how this one idea literally influences billions of dollars in the market and can affect the value of companies you might even own. At its core, this whole topic is really about a fundamental clash. It's a debate between two very powerful and totally different ideas about what makes a company valuable to its shareholders. So, here are the two sides of the ring. On one side, you have the dividend irrelevance theory. It basically says investors are smart, rational people. A dollar is a dollar, whether you get it as a cash dividend or the company reinvests it to grow. But on the other side, our focus today is the bird in hand theory, which says no way, that's not how real people think. It argues that dividends are absolutely crucial because they're a sure thing. Let's dig into the logic here. Why exactly does certainty pay off? Why would some investors always take a guaranteed payout today over the mere promise of a bigger reward down the road? So here's the official definition for you. It was developed by economists Myron and John Lintner, and it all boils down to this. Investors value the certainty of cash in their pocket right now, way more than the potential for the stock to be worth more in the future. It's a straight-up battle, certainty versus uncertainty. And this captures the idea perfectly. A dividend is a sure thing. Once a company says they're paying it and that money hits your account, it's a real, tangible return. That is the bird right there in your hand. But future gains? The hope that your stock price will go up over time? Well, that's the two in the bush. Those gains depend on so many things. The company doing well, the market not crashing, a million different risks you just can't predict. They are, by their very nature, uncertain. And this gets to the psychology of it all. See, most of us are risk-averse. We're just wired to prefer a sure thing. Getting that dividend check reduces the feeling of risk and gives a sense of security, especially when the market is going crazy. It's also like a signal from the company that says, hey, we're stable, we have real cash, we're doing just fine. So how does this preference actually affect the stock price? Well, Myron Gordon's model lays it out pretty clearly. A company starts paying a higher dividend. That makes risk-averse investors feel more confident, right? They see it as a safer bet. So demand for that stock goes up, and that, in turn, can actually push the price higher. Certainty literally gets priced into the stock. But of course, it's not that simple. No theory is perfect, and this one has some major counterarguments. So let's flip the coin and look at the criticisms to understand why not everyone is chasing that bird in their hand. The biggest critique is that the theory oversimplifies things, and a huge part of that is taxes. For a lot of investors, capital gains are actually better because you don't pay taxes on them until you sell, and even then the rate is often lower than it is for dividends. Plus, and this is a big one, if a company reinvests its profits into amazing new projects, that can lead to massive growth down the line. I mean, think about a fast-growing tech company versus a steady utility. They attract totally different people for exactly this reason. So, with all these valid points against it, why are we still talking about this theory? Well, because even with its flaws, it shines a light on something incredibly important about how markets really work. The real power of this theory isn't about the numbers on a spreadsheet. It's about human psychology. It's a reminder that investors are people, not robots. Our feelings about risk and our desire for a sure thing are incredibly powerful forces that shape our financial decisions. And this right here is the key takeaway. The theory proves that a dollar you get from a dividend is not the same thing as a dollar you might get from a stock sale later on. They're just different. Depending on your age, your goals, and how much risk you can stomach, you're going to value them very, very differently. And for the companies that lean into this, there are some real perks. They tend to build up a super loyal investor base, and their stock price doesn't bounce around as much. They get this reputation for being stable and disciplined, and they attract a whole group of people who are looking for exactly that, a steady, predictable income stream. Which brings us to the real world. Who are these investors? Who is actively building their whole strategy around this idea of certainty? Well, just think about it. Retirees who need that predictable income to pay their bills, or mutual funds that are literally called income funds. And of course, anyone building a more conservative portfolio, where stability is way more important than shooting for the moon. So I'll leave you with this final thought. When you think about your own money, your own philosophy, where do you land? Are you looking for that bird in the hand, the reliable, certain return right now? Or are you willing to wait for the chance at 2, maybe even 3 birds in the bush later on? The answer tells you a lot about the kind of investor you are.